Yo, what's going on, everyone? Welcome back to another video. Today we're going to talk about liquidity in the Forex market cycle. So consider this part 2 of the 3-part series. This is a continuation of the previous video I posted, except in today's video we're going to talk about liquidity and we're going to connect that to the first topic. So without further ado, let's get straight into this video. Actually, before we get into this video, I just wanted to quickly plug in the course and mentorship. It's currently on discount. It's $100 off the normal original price. The undiscounted price is $265 one-time payment, but I've decreased it by $100, so it's on a discount price right now. And if you're wondering what do you get in the course, this is everything: phase A, phase B, phase C, phase D, and then you get the final stage, and then some extra case studies, live scalping examples, and etc. And on top of that, we also have a section right here. It's called the links channel. I'm not going to click it because if I click it, you will have access to all of the private content and the Zoom calls and the live trading sessions, and I've made that mistake before, so I'm not going to make the same mistake again. But yes, you also get access to that and this Discord channel where we do live trading sessions and etc. So if you are interested, right now is your chance to get involved. So just click the link in the description and I'll see you in the Discord. But without further ado, let's get straight into this video. So first of all, usually when we talk about liquidity, we get that boring technical example: oh, buy at support, don't sell at resistance, there's money all over the market. Instead of that, we're going to talk about the linguistic definition of liquidity. What is liquidity? Liquidity is very simple. It's money. That's all it is. It's a dollar sign. It's this, right? When you have $10 in your pocket, you have $10 of liquidity. You're liquid. When someone goes to the bank and the bank says, how liquid are you? They say, I'm $2 million liquid. That's what it is. Liquidity is money. And money is stop loss. In the market, money is stop loss. What do I mean by that? Okay, so I'm going to do exactly what I said don't do. I'm going to give you that support resistance example. Let's assume you're looking to buy the market. Price action enters a level of support and you decide to buy. Cool, makes sense. Now what you're going to do is you're going to set your stop loss at the low of that support. Let's assume you have a $100 account. 1% of 100 is $1, right? Assuming you're only risking $1 of your capital, essentially you're risking $1. So your stop loss is worth $1. And wherever the most money is accumulated, that's where the banks are going to target. They pinpoint those levels and they go and they snipe that money and take it, put it in their wallet, run away, and go out. That's literally what it is. Now, of course, it's not like that. That's just an analogy of, you can pretend what the market maker is like. So now we understand what liquidity is. Liquidity is just money, and money is stop loss. So if I have a $500,000 stop loss, or I'm risking $500,000, my stop loss is $500,000. So stop loss is money. Now the banks are going to target wherever the most money is. So wherever the most stop losses are. Now stop losses are also money, so it goes hand in hand. Wherever the most stop losses are, that's where the most money is going to be. So assume that all these support and resistance traders are buying at this level of support. What will happen is the market makers will see this money and they're going to take it like any person of reasonable, or not reasonable, but any person of intellect would. If you see that there's a lot of money over there, like you see $1 million literally just sitting there collecting dust, you're going to grab that money and take it. That makes sense. So what happens is the market makers, they reverse the market, they break the level of support, and as they break the level of support, all that money is being grabbed. It's being picked up. And what I mean by picked up is literally is that the market makers take your dollars, they take the money, they put it in their pocket, and then they put that money in the order, in the direction which they wanted to take price initially. So if the market makers wanted to take the market up, you were right about the direction. The only problem was you were wrong about the timing. Because if you knew that there was money resting below, you would not have bought as soon as the market tested this level of support. Rather, you would have bought later on. And this example works vice versa for the resistance. So if I flip my chart right now, how do I do this? I forgot. Okay, I forget. I don't know how to do this. I used to be able to do this, but yeah, here we go. Invert scale. It's the same thing. Assume that you're selling, you have a $1 stop loss, and every single person in Pakistan and India and Bangladesh and Saudi Arabia, they're all literally selling here. But the market makers are going to see that because you're in their hierarchy. They are in control of the agenda. They're in control of the narrative, essentially. And it's their prerogative to take all the money and then reverse the market. Right? That's what it is. So when they see all that money is scattered over here, and they see that it's just collecting dust, they're not just going to sit there. They're going to take the money and reverse the market. And then we get stopped out. So we are liquidity. We are literally the money that the market maker is trying to go for. Now, how do we implement this into Forex? Well, I have a beautiful example on Euro USD. When I'm gonna hide the chart. There's no drawings, nothing. This is just a blank chart. Matter of fact, let's go right here. All right, ignore this. Just here. Okay, cool. At this point, as you can see, it's a brand new chart. What do you guys see? Right? Well, what I see is that we have a level of resistance right over here that was tested multiple times, and then a level of support. We all know the philosophy, and if you don't know it now. Note this in your head. The philosophy in FX is this: when everyone is greedy, be patient, and when everyone's scared, be greedy. Execute. Execute patience. You need to know when to execute. You need to know when to be patient. At a time like this, when the market is trading within a range of resistance and support, where things are just bouncing up and down from support to resistance, support to resistance, support to resistance. At this point, you do not want to be a participant in the market, because the majority, the 99%, are participants. If everyone else is doing the same thing, if I know that everyone is looking to sell at this point and everyone is also looking to buy at this point, then that literally means that the market maker is planning to do the opposite. That also means that there's money resting below and above these levels. So if I'm looking to enter in either one of these markets or either one of these directions, if I want to be a seller, then that means I have to wait for the market to grab this money first. Now, what you're also going to notice is right above these levels of liquidity is going to be an important key interest. Sorry, an important level of interest. So, for example, you have a move up, and you after that move up is followed with a strong move down, right? This, that, and then this is where the manipulation starts, where the market creates that, higher, not higher, sorry, but the support resistance. Now, just above that support and resistance level, you're going to be met with a level of demand, sorry, not demand, a level of supply. And just below that level of supply, where the support is, so right below the level of support, you're going to see a level of demand. So what you're going to notice is that the market will actually take out all of the sellers first, approach the key point of interest, mitigate the key point of interest, provide smaller time frame confirmation perhaps, and then from there the market makers will dump the market down and target next, which is the buyers, the people who are buying. Wherever the money is, wherever the majority of the dollars are, that's basically where price action is going. And this is what we saw here. What we see is that there's money up and down, above and below. So what's my job? My job is literally just to find the level of the key point of interest that I was talking about, and that key point of interest can be found right over here on the 5-minute time frame. You can see that it's this 5-minute order block, right? And we're going to extend it to this high right over here, because this is the high where sellers took over and buy pressure was diminished. It was no longer in control, right? Now the narrative is being controlled by the sellers. So what the majority are doing and what the majority are thinking at this point is, I have to sell, I have to sell, I have to sell, but not realizing that everyone is selling, so that makes it wrong, right? And what the smart money trader is doing is he's saying, okay, I know that everyone is selling here, so that means that this level is like a level, like it's like a it's like a basket, and the market maker is gonna shoot a 3 into the hoop, and it's gonna swish, right? So now when the market maker is gonna bring the market up, the smart money traders are being patient at the moment, and this is the key point of interest. So this is where we are gonna execute and look to get involved in a trade. As you can see, the market approaches our area of supply, and let's take a look at what happens next. Now, I'm not going to get too deep into the smart money, sorry, not the smart money. I'm not going to get too deep into the lower time frame confirmation part, right? Because that's a whole topic for another video, but it can't get any better than this. As soon as you understand the liquidity, as soon as you know where the money is, then you're set. You know when to enter and you know when not to enter. That's all you need to do. All you have to know is when to be patient and when to execute. Because it's either you're going to see the liquidity or you're going to be the liquidity. If I can see the liquidity, then I know that I do not need to be a participant in around these areas of the market. But if I do not see the liquidity, then I'm going to be the liquidity, because I'm essentially going to be entering at these points of interest, right? And your job is to train your eyes so well to the point where just approaching the markets, just seeing this for the first time is so obvious. As in, you want to become so well educated and so well trained and learned in this liquidity mapping process that the second you open up a chart, it doesn't take more than a minute to 5 minutes just to find the liquidity. And it's literally that simple. As we can see, the market enters our point of interest, and then from there the market starts going down, right? And all of these traders who were looking to short at around these levels, of resistance, they had all of their stop losses hit, right? Because where are their stop losses? It's literally just they usually go for 1-to-1, so their stop loss is relevant to their take profit, which is a 1-to-1. And as you can see, after they get stopped out, what happens? Well, now their money's gone, but then they're thinking that the market reversed, that it's a buy side market now. Resistance has turned into support, and then it's an entire cycle. They start to buy. What happens? The market takes you out there as well. Now, after we reach the level of supply and we reach this key point of interest, the market will now reverse in the opposite direction to grab the orders in the opposite direction. So wherever the most money is. So notice how quick this move was and how strong it was. It was like a child who sees an ice cream truck and he's like, "Dad, give me $5. I want to buy ice cream." And he starts running with full force. And that's exactly what happens here. The market makers saw all this money. They saw the ice cream truck. They saw how much money was here. And they did not take a second. They did not even take a second. It took them a millisecond to reverse the market to grab all that money. Because no rich person in a suit who works for Wall Street or who works for a hedge fund or who works for a bank is not going to just let money sit there and collect dust. They're going to grab the money. And what happens next is that the market sells off to grab all these orders. Now, what were the retailers doing at this point? Before the market even reaches this point, right? You have two types of retailers. You have the ones that passively enter, and then you have the ones that enter aggressively. Now, the aggressive retailers are the ones who enter with market orders, and the passive ones are the ones who enter with the limits, because that's a passive entry. Now, even if you entered with a limit, you have no luck, because at the end of the day, your take profit, or not your take profit, but you're entering at the wrong place. And you probably would have caught slippage at this point too, because of how quick this move was. It was like a flash crash. But the market basically reaches this level of support, and it just breaks through it, grabbing all that money. Now, the ones who would market execute it, I guess they would have been safe at this point, because the market didn't even provide a second. It literally just sold off without any break whatsoever. What happened next, though? What's the next philosophy? Like I said before, there's going to be a key point of interest below the level of liquidity. And in that case, that key point of interest is right here. It's this 12-hour area of demand. Now, we're going to refine this level, and we're going to refine it down to this area. And you can see that after that, the market it had a very nice reaction, a very, very nice reaction. Now, you might be thinking it only reacted for about 98 pips. We only had an effect of 98 pips. But if you know the entry models to how you could have implemented the entry models to catch an entry, 98 pips is a lot, especially according to the percentage of your account, right? Assuming that you're only risking 1%. That 98 pip with a 1% risk is a lot. That could be possibly like a 10 to 15 RR, right? According as long as your stop loss is small and your take profit is relatively higher than your stop loss. So yeah, as you can see, that would have been a 5-to-1, which is very beautiful. Right? As you can see, the market enters its point of interest. As soon as that point of interest is mitigated, we look for the reversal, and the reversal was met right over here. And then from there, the market reaches this last 15-minute order block, institutional candle, and the market reverses, hitting take profit. Well, not actually hitting take profit, but because take profit would have been somewhere around here. But the market ends up reversing, creating what? A new level of liquidity. Now we have resistance here. Now we have support here. So essentially, this is the beauty of understanding liquidity. We now know where the liquidity is. I know that now the low has been taken out. So the money here has been taken out. All that's left is for this money to be taken out next, right? Now, there's going to be different times and different situations where the market leaves some liquidity to pick up later. And sometimes the market doesn't leave liquidity, picks it up right away. Like as in, for example, the market sold off and is probably going to continue to sell off until this point over here. But later on, we might pick up that money. But for now, that money is going to stay there, and the market maker is going to remain patient until it comes with this next move. Now, how does this connect to our first topic? Our first topic was about market cycle. And the first market cycle was this one, right? The market cycle where the market does something like this. It reaches that point of interest, and then it sells off. And for the next few weeks to months to years, the market just follows this pattern where it just continues to sell off for a couple of months until it reaches the next point, right? Now, how can we understand this? Well, if you take a close enough look, what is this right here? This is phase number 2. Before the market even sells off, you have that liquidity grab. Right here, you have this level of support and you have this level of resistance. And the market grabs a resistance and then grabs a support, and then it sells off for the next couple of months to weeks to possibly even years. As I've showed you on the previous video, as GBP USD would literally sell off for the last couple of months, almost to a year. So that is part 2 of the market cycle. This market cycle is called the liquidity cycle, where the market creates a level of manipulation where support and resistance traders think that they're in control, and they think that the market is going to continue this pattern until we all pass away. Like, really think about the logic behind that statement. Do you think that the market is going to constantly follow this level of support? Every single time the market reaches the support, it's going to go up, and every single time we reach this level of resistance, the market is going to go down. Like, that doesn't make sense logically, because if that's all that would happen, then everyone would be a millionaire in this market. Everyone would be a millionaire. But it's the opposite. The opposite is the fact. The fact is that almost 98 to 95, I've seen the number change to vary. It goes from 99 to 90 to 50 to 96 to 97. The main point is that a lot of people lose money. Not a lot of people, but majority of the traders who enter this market lose money. So this is part 2 of the part 3 of market cycle. Stay tuned for series number 3, or part number 3 of this 3-part series, as it's going to come out tomorrow or preferably this weekend, inshallah. But thank you so much for watching this video. I hope this video was helpful. I hope this video opened your third eye and allowed you to see the market. Actually, no, ignore the third eye comment, but I hope it allowed you to see the market with a more technical perspective and a more conservative approach. And by the way, after you watch this video, go to the markets, go to the tradingview.com and backtest what I just taught, what I talked about, because essentially this is key. Right? And if you can backtest this, you're going to train your eyes to seeing the liquidity, so that the next time the market opens, you're going to know what to do. But with that being said, appreciate you taking your time watching till the end of this video. I'll see you till next time. And it's been amazing. It's been epic. I'll see you all next week. Peace out.